Hey everyone, mortgage rates are on the rise again, and Fannie Mae just came out with an announcement that tightens the lending standards for investment properties and second homes. And it's a good indication that the mortgages tied to those properties are probably going to get more expensive moving into the future. In this video, we're going to cover how rising interest rates and recent changes impact your purchasing power. Welcome to Macro Thinker. If you are new to the channel, please consider smashing that like button to push the content out to more people, and tap that subscribe button to see more weekly videos on finance, real estate, and investing. My name is Lewis. Let's get it. So the first thing we're going to take a look at is the 10-year Treasury yield, and we're going to see how it's been rising over the last several months. Now, in prior videos, I've described how mortgage rates tend to follow the 10-year Treasury yield in lockstep fashion. In other words, if the yield rises, mortgage rates tend to rise. If the yield falls, mortgage rates tend to fall. So up on the screen here, I have the 10-year Treasury yield, and I'm just looking at a one-year chart, and it is currently sitting at 1.732%. And if you go back to July and August timeframe, you can see that the yield was substantially lower at 0.536. So we've seen more than a 3x increase just in the last roughly 6 months or so. And even though mortgage rates do not follow it exactly, like mortgage rates certainly aren't 3 times higher than they were 6 months ago, but it did lead towards those rising rates. We've seen the mortgage rates move from maybe, in the mid 2s to kind of like the low to mid 3% range. Next, we're going to take a look at where the 30-year fixed mortgage rates are today. So I have up on the screen the published mortgage rates by Freddie Mac for the week of 3/18/2021. And you can see that the 30-year fixed rate is sitting at an average, national average of 3.09%, with approximately just a little bit under 1% in points and fees. And if you look on their chart, you can see that rates were kind of hovering right around 2.65%. Basically 2 months ago, and now they're up about 0.5%. The one thing I do want to note on this particular chart is that they update these weekly, and we've seen a pretty large and substantial spike in the 10-year Treasury yield this week. So I would imagine that the rates that they publish next week will actually be higher. Okay, so we know mortgage rates are on the rise, and they've moved up from the mid 2s to the low to mid 3% range. So what we want to find out now is how that actually impacts your purchasing power on a primary residence. On the screen, I have a mortgage calculator, and I'm just going to do it with a $300,000 loan amount, and we're going to estimate that the mortgage interest rate is 3.25% on a 30-year fixed. Your principal and interest payment on that would be $1,306. And so we're going to pull up a calculator, and we'll use $1,306 as our base payment, and then we're going to look at what that was a couple months ago with a 2.625% rate, and we'll compare the difference. With this 2.625% interest rate, 30-year fixed, we were at $1,205 versus $1,306, which is a difference of $101 per month. So what's happening here is that rates are rising, and it's decreasing your purchasing power by about $100 if you're looking at a $300,000 loan amount. Now, this is all relative. So if you have a lower purchase price with a lower loan amount, then the difference will be less than $100. If you have a higher payment with a higher purchase price, then the payment difference will be over that $100 threshold. Now that we know how the rising interest rates impact your purchasing power on a primary residence, let's take a look at the recent announcement by Fannie Mae. So I have an article up on the screen from housingwire.com. And the title is Fannie Mae Tightens Standards on Investment Properties. So what this article states is that Fannie Mae is tightening the underwriting criteria for second homes and investment properties. Recent amendments in our senior preferred stock purchase agreement with the Treasury impose additional risk criteria on the loans we acquire. The GSE, which is the government-sponsored entity, it's Fannie Mae, they said that in the letter. One of those restrictions is a 7% limit on our acquisition of single-family mortgage loans secured by second home and investment properties. Now, I haven't seen any data around this, but I have heard that currently mortgages secured by second home and investment properties are hovering around 10 or 11% today. So it seems as if they are trying to slow down the volume of those types of loans they receive. Additionally, Fannie Mae said that the amendment has prompted changes in the eligibility policies. All second homes must be underwritten with desktop underwriter. For those of you who don't know, that the desktop underwriter, or DU, is an automated underwriting system that you basically package up a loan file with all the details, income, assets, liabilities, credit report, everything, and you run it through this automated underwriting system, and then it gives you a score. And ultimately what you're looking for is an approve eligible in order to ensure that that loan will be deliverable to Fannie Mae. In other words, it meets all of their guidelines. The above policies apply to all lenders and include loans delivered under negotiated terms. The only exception that will be permitted for second homes and investment properties is for high LTV, that's loan to value, what you owe versus what the home is worth, refinance loans that are manually underwritten in accordance with the alternative qualification path and delivered with a special feature code 840. I don't really know exactly how many of those loans are delivered in that fashion. I would imagine it's a very, very small percentage. So in other words, they are looking at the bulk, probably 90%, 95% of the loans that are delivered, and they're saying, hey, look, they have to meet these guidelines. So the real question is how does this impact you as a borrower? Starting April 1st, moving forward, Fannie Mae is going to put a 7% limit on the acquisition of single-family mortgage loans secured by second homes and investment properties. What we don't know entirely is what that is going to do as far as impacting the interest rates or the purchasing power. So earlier we talked about how the interest rates are moving up, and we haven't really seen any official guidance on how these new standards are going to impact rates on these types of properties. However, I have heard rumors that on investment properties and second homes, we're going to be seeing new loan level pricing adjustments that impact the rates. In other words, rates are going to likely rise, which is going to impact your purchasing power for second homes and investment properties. And so far what I have heard, but I haven't seen any data to support it, I'm just going to share it with you. We're going to see second homes with an additional loan level pricing adjustment of 2.25%, which gets built into the margin. And my estimate on that is it's going to increase the actual interest rate on a 30-year fixed mortgage by about 0.5% for a second home. On the investment property side, I have heard rumor that we're going to see a loan level pricing adjustment of about 0.5%. What that means in a 30-year fixed interest rate is that we might see another 0.1% or 0.25% higher on investment property loans. That's relatively minor. It's not going to make a dramatic difference in the purchasing power. And if your deal still pencils as an investor and the property still cash flows, you may or may not be too upset about that. But on a second home, those were traditionally priced like a primary residence. So as a primary residence, you might be able to lock into a 30-year fixed rate today at 3.125. And if you were buying a second home, you probably could have done the exact same thing, 3.125%. Well, with that massive loan level pricing adjustment, potential pricing adjustment, of 2.25%, you build that into the margin. Now, all of a sudden, that rate's about 0.5% higher. Probably going to see those rates on second homes move up to maybe close to what an investment home would cost you previously. All right, so that's going to wrap it up for today's mortgage rate update. If you found the information useful, please consider tapping that subscribe button to see more weekly videos on finance, real estate, and investing. And if you haven't done so already, please consider smashing that like button. When you smash the like button, it helps push this content to more people, really helps grow and promote the channel. Really appreciate you taking the time to watch. We'll see you on the next video. Take care.